Today, I'll be explaining how to do your US crypto taxes with Koinly. Hello, my name is Nelly from Koinly and welcome back to another video. If you're one of the millions of crypto investors who's wondering how on earth to figure out your crypto taxes, or if you need to pay your crypto taxes in general, this video is for you. Today, I'm going to explain how to file your crypto taxes in the US and with the least amount of headaches possible. So we'll look at a few different things. Firstly, what you need to understand about your crypto tax implications, how to aggregate your complete transaction history from all the platforms you use, how to calculate your gains, losses, and income in dollar terms based on your transaction history, and finally, how to report your crypto in your tax return forms. Okay, so remember how I said we're going to make crypto taxes pain-free? Well, if there's one thing you need to remember from this video is that doing your taxes manually could take days. And the worst part is you'll probably come out with the wrong totals and end up paying more in tax than you need to. So make sure to use a crypto tax calculator like Koinly and make sure you get a really solid and detailed report so you don't pay more than you need to. And the IRS has no reason to knock on your door with an audit. Koinly has been supporting crypto investors with a fully IRS compliant tax reporting system since day one. So if you're looking for a solution right now, it can be as simple as jumping onto Koinly and connecting your wallets, exchanges, and blockchains. Once Koinly has your transaction data, it does all the complex calculations to figure out what your taxable income and into which category it falls. For example, was your profit from crypto a form of income or a capital gains? And if so, were these short-term or long-term gains? And what was the value in USD dollars on the day you received them and the day you sold your coins? It's Koinly's job to calculate the complex data correctly and show both the totals and the itemized transactions in the report that you can download or even upload to TurboTax or TaxAct. We'll definitely come back with some tips on setting up your Koinly tax report, but I just want to let you guys know upfront that it can be really as simple as that. Okay, jumping in, let's talk about the tax rules surrounding crypto. Now, there's obviously a lot going on in the media around taxes and regulations, and we could go into this for hours, but let's just get to the bottom line here. The IRS has been really clear that cryptocurrency is definitely taxed, and they're able to track crypto investments through various channels. So any income you make from your crypto has to be reported in your annual tax return. It's just a matter of whether you're up for capital gains tax or ordinary income tax. Okay, let's start with capital gains as this is the most common tax scenario. Briefly, we'll look at when this applies and how much you have to pay. So first, if you're selling and making a profit, that profit would be taxed as a capital gain. It's important to know some accounting terminology here. The first term being dispose. Capital gains tax applies every time you dispose of your crypto asset. Let's think of dispose as changing hands, or more correctly, to transfer the control or ownership. Understanding this is important. It means that even if you simply swap one crypto for another, your crypto has changed hands, which triggers a capital gains event in the eyes of the IRS. If you're doing a manual calculation of the profit you made from a trade, you need to know the cost basis of both coins on the day you acquired one coin and on the day you swapped the second coin. Keep in mind this counts for swapping stable coins too. Okay, so if you spent your crypto to buy something and your crypto's value is higher on the day you spent it than on the day you bought it, you've made a disposal yet again, and this triggers a capital gains tax event. Anytime you sell, trade, or spend your crypto, you'll have either a capital gain or a capital loss. Now, looking at how much capital gains tax you'll actually need to pay, it'll depend on how long you've held your asset for and how much you earn. If you've held for less than a year, you'll pay the short-term rate, which is the same rate that your regular income is taxed at. Typically, these rates change a little bit every year, but here on our US Crypto Tax Guide, you can find the latest federal income tax rate brackets. This table gives you an idea of the percentage of tax you could pay on a short-term gain. It starts by asking what your annual income is. Just remember, the IRS is not looking for just your salary to figure out each bracket. It's your total income that counts here. Salary, investments, everything. And as you can see, the tax rates range from 10% to 37%. Meanwhile, if you hold your crypto for 12 months or longer, you're taxed according to a different tax table, and that's the long-term capital gains tax rate. And again, it's based on your annual income. And here in our guide, I can see that the long-term tax rate is between 15 and 20%, which at its max is far lower than the short-term rate. But also, if you notice in the long-term tax table, you only start getting taxed on your long-term gains if you earned more than $40,400 in the 2021 financial year. Okay, so that's the gains. But what if you had a loss from your crypto in the last financial year? The good news is you can use losses to lower your tax bill. Let's zoom back a little for a second and keep in mind that crypto might only make up a portion of your investments. You may also own stocks, perhaps a rental property, and other assets. So when we talk about how to use your capital losses to your advantage, we need to consider what your total position is on all your investments, your net capital gains position. Going from there, here's 4 scenarios that could play out for crypto investors. Number 1, let's assume your crypto performed poorly, but your stocks had a good year. You can use the capital gains from your crypto to reduce your overall tax bill. This can be done by using your crypto capital losses to offset your total or net capital gains. Number 2, let's say you only trade in crypto, or if you did have another investment category that had no profit. If you don't have capital gains to offset your crypto loss against, you can use the loss to offset your ordinary income, up to $3,000 a year, and you can keep doing this in future years until your losses have been used up entirely. The third way to use your crypto taxes is to choose when to use your losses. Just because you had a crypto loss this year doesn't mean you need to offset that loss this year. You might know from watching your portfolio that your profit from crypto or any other investments is going to deliver a bumper crop and with a huge tax bill. If you're strategic, you can save your losses to carry them forward to offset against future gains. Now, if you experienced a loss to your crypto portfolio due to a hack or a scam, the IRS will not allow stolen or lost crypto to be claimed as capital loss. What you'll do is just write off the loss, meaning you can simply disregard the loss from your portfolio calculations entirely because it's likely never going to be relevant in terms of tax purposes. Okay, now that we've covered capital gains, let's look at when your crypto might be taxed as an income instead. There are many crypto transactions that can be viewed as income, and they might not always feel like they belong in the income category. The IRS has indicated that crypto income can come from being paid in crypto. That's a pretty easy one. Also from instances where you make new coins through mining, for example, or when you receive new coins from various reasons, and in instances where crypto earns you interest. So let's look at a few scenarios starting with airdrops and hard forks. So when you receive coins from either, you're typically paying income tax. And the day you sell or dispose your airdrop assets, you'll pay capital gains tax. Alrighty, on to mining. Any crypto you receive from mining counts towards your income for the year. Okay, so what about NFTs, you might be wondering? If you've sold an NFT as a creator, your profit will be taxed as income. If you're selling or swapping an NFT as a collector, that will count as a disposal of a crypto asset, and you'll be up for capital gains tax. Moving on to DeFi. While the IRS has not given solid guidance on this yet, it's likely that anytime you're seen to be earning from DeFi, whether that's a new coin or tokens, the IRS will view that as an income. This could be, for example, earning interest through yield farming on lending protocols like Aave or Compound. Or it could be earning new liquidity pool tokens, governance, or reward tokens on protocols like Uniswap. Or you could be lending your crypto on platforms like Nexo to earn interest, or earning crypto dividends on platforms like CoinRabbit. And in many cases, when you're making gains off crypto you own, it looks like income to the IRS. Of course, DeFi transactions can also trigger capital gain tax events. If you're interested, our DeFi tax guide is a really good resource and it's updated regularly. Okay, so now we understand more about the way crypto is taxed. Let's take a look at what you need to calculate your crypto totals in order to report your crypto in your tax return. So to get to a point where you can file, you'll need to do a few different things. Get a complete view of all your crypto activities from every platform and from day one of your investing journey. Your complete trading history needs to be aggregated in a single chronological record and in terms of US dollars. It's only by getting all this data together that you'll be able to separate out your capital gains in terms of long-term and short-term gains, accurately record your losses, and be able to calculate your income from crypto. Once you know your totals, then you'll go ahead and file, and we'll show you how to do this in a minute. So to get your numbers, really the only way to get this right is to use a reputable crypto tax software. Since Koinly supports over 600 exchanges, blockchains, and wallets, it's incredibly easy to import your trading history into a single, cohesive dashboard. Once all your data is in, you'll see that Koinly has calculated all of your transactions in US dollar terms. Koinly's historical US dollar price lookup feature is a massive time saver just in itself. Koinly can handle a lot of the complexities that come with crypto trading, like identifying deposits or withdrawals related to staking pools, tagging airdrops, forks, and so on. It's also super important that Koinly is able to identify tax-free transactions like times when you've transferred crypto between wallets you own. If incorrectly tallied, this could be reported as a disposal and blow up your tax bill. Koinly is designed to avoid these mistakes. Okay, next, Koinly calculates your taxable position, including short-term and long-term gains, losses, income, and expenses. All of this information is collated into a easy-to-read summary with various crypto tax reports to download, including a complete tax report, transaction history, capital gains report, income report, and many more. Koinly also generates specific tax reports, specifically for the IRS. For example, the IRS Schedule D form. You can download your report to file with, or even invite your accountant to review your tax report directly from Koinly. Okay, so this brings us to the final part of this video. Once you have your crypto totals, you'll report to the IRS as a part of your annual tax return. One of the quickest ways to do this is to import your crypto records into a tax app like TurboTax or TaxAct, and Koinly has an uploadable report that is designed specifically for this. If you're filing for yourself or with an accountant, you'll file in 4 steps. First, if you have capital gains or losses, the complete tax form for cryptocurrency, Form 8949, with all your taxable transactions. Koinly has this exact form available for download, pre-filled with your transactions. Second, include your net capital gains and losses from Form 8949 on Form Schedule D. This includes your short-term and long-term capital gains and losses. Third, if you have income from airdrops, forks, liquidity pools, bonuses, and so on, you'll need the complete Schedule 1, generally under the Other Income section. If you are self-employed or operating as a crypto business and have crypto income, you'll use the Schedule C instead. And fourth, complete Form 1040 and attach the other forms you completed. File this together with the rest of your income for the year and you're done. But that brings us to the end of this video. If you have any questions, I'll leave some resources down below, starting off firstly with the Koinly Help Center, where we have countless different articles on crypto related topics, the feedback section where you can report any bugs or issues you might be having, a Koinly Forum section where you can talk to members of our community as well as our staff, and then lastly a contact section where you can send us a message directly and we'd be happy to get back to you. But if you found this video helpful in any way, consider dropping a like, subscribing for more crypto content, and I'll see you next time. Peace.